Hi everyone, welcome again to another financial analysis video with myself, Moed Amin, and my colleague, Ted Wainman. Today we're going to be looking at an interesting business in terms of their technology, a company called Tissue Regenix Group. So quick dive into what Tissue Regenix do. Essentially, they are involved in regenerative products and technologies to help with tissue engineering. So basically they help with the natural recovery process for tissue regeneration. They've got a couple of technologies there that you can see on the screen, D-cell and BioRinse. I'm not going to go into too much detail about both of them, but I'll explain a little bit about D-cell so that you get an idea and some context behind the numbers that we're about to share with you. So think about D-cell technology. So think about DNA that sits in every living cell, every living organism. And that DNA is encased within each cell. Now, the cells are encased in the tissue structure. So think about the tissue structure as the scaffolding. Now, when that tissue structure, that scaffolding starts to break down and it's not repaired, that can lead to things like disease, injury, wounds. So if it breaks down enough and someone has a tissue transplant, what often happens is those tissues, well, not often, but what can happen is that those tissues can be rejected a lot of the times because the host tissue, the scaffolding, is still damaged, right? Or the tissue of the actual donor is also damaged. So their technology basically helps clean out the DNA and any cellular debris from the donor's tissue, so that when they put that into the host tissue, there's less scaffolding damage, and therefore that tissue is going to be accepted, and therefore will help encourage self-regeneration of those tissues. So it's a very interesting technology, and it's a patented technology that they have. BioRinse is similar, but think about it for bone structures. So we're going to go into the finances of this company, but a quick note before we go into the finances. So a couple of things. Two people requested this analysis, two of our viewers. So Osman and Daniel, here is your video. Hope you enjoy it. And don't forget to like, share, subscribe. And if you're a subscriber and you make a request, you will receive notification when we publish the video that you requested. We're also going to talk about the share price. Now, quick note about share price. It has fallen, right, since the very beginning when they had their IPO. And we're going to dive into that later on and talk about what the finances and how that looks like in context to the share price. It's not going to be up to date, but at least we're going to help you analyze what to look for in your investment thesis. So it's important for you to know what to look for. So Ted, let's dive into this one. Particularly interesting company, especially interesting technology as well.
Yeah, good to see you, Moed. So thank you very much. I have to admit, you slightly lost me on all that DNA explanation. I think I'm going to stick to the finances. I find it a lot easier, if that's okay. So yeah, we're going to look at the financial statements, and here they come. So we are looking here at their annual report and accounts. Now, their annual report and accounts is out of date. If you want to tell me that they're out of date, you are more than welcome to. Please do so in the comments, but please be polite. We are going to whiz down through to the financial statements. So if you want to know more about what the company does and how it does it and why it does it and why this is such a great company with a great board, then you should be reading these accounts. But we're going to whiz down to page 71, which will find the income statement. Now, do remember that if I'm looking at the numbers, okay, and I'm telling you what the numbers are telling me. I don't know anything else about this company. So if you want to add your kind of your insight, additional knowledge, please do it in the comment section, and obviously don't forget to like, share, and subscribe. So what do we see in the income statement? Well, this is what I can see. The revenue is the top line. This is the sales figure. You'll notice the sales figure dropped only slightly, but it has fallen a little bit, about 2%. Cost of sales are about 54%, which means that they are making a profit, which is good, a gross profit of 46%, very consistent with the prior year. So the gross margin is consistent. However, they've got high overheads. So these overheads are causing them to make a loss. So this company is clearly still sort of marching towards profitability. It needs to kind of, get to the stage where the sales and the gross profit exceed the costs of running the business. And then also we noticed in 2020, they took a great big hit. Okay, this is an exceptional item. This is the write down or the impairment of an intangible asset. Intangible asset, something you cannot touch. So that's such a big number and it has such a big effect on our accounts that I think we ought to really just pause and go and have a look at note 4 to find out exactly what it is. So note 4, I think, is on page 87. So let's just whiz down to page 87. Here it is. And note 87 talks about the intangible assets. And here we can see the actual the impairment. There's the 6 the 6 million of impairment, and we need to kind of understand what it actually relates to, and we can do that by looking at reading the notes, and the notes are a little bit later on. So here's the note here, and it just talks here about the write down in one of their investments. So they're looking at this Right Cell Technologies LLC, and they talk about, they carry it at a certain value. They look at the kind of, the expected future cash flows and value it based on that. And if those cash flows start to go south, then they have to take a write down. So that's what they're doing here. They're doing a big write down in the value of one of their investments. So that's kind of, but that's in the past. That is in the past. So maybe that's kind of set them on a better footing. But as we said, the company is making a loss. So bottom line is making a loss for the year. And even if it didn't have the impairment of the exceptional item, that's up here, if you remember, then they would still have made a loss. It wouldn't be 9 million, but it would still be a fairly substantial loss. So it's just worth bearing that in mind. Okay. And just to sort of note that we are actually talking in pounds thousands. So this is a 9.7 million pound loss, up from 7 million pound loss, although the previous year they didn't have an exceptional item. So they have managed to get their overheads down. They are doing cost cutting. They are aware that they need to take some fairly drastic action. So sales have come down a little bit, and the administrative costs have come down significantly. They are doing a cost cutting, but they still have some way to go to get those costs down. Let's have a look at the balance sheet, see what's going on there. Just out of interest, you'll notice there's a little bit of finance charges here. So we should find a little bit of debt somewhere in the balance sheet. Nothing excessive there, but what we tend to do is compare the finance charges to the operating profit to see they can afford it, but they're making an operating loss. So we know that is an issue. Here is the balance sheet, the assets. So the first thing we notice is the intangible assets. They've fallen significantly because of the write down. So that's basically they've written off the value of an investment in that particular organization, that particular company. Otherwise, we can see our the current assets. Let me just scroll down a little bit so we can see the rest of the balance sheet. So we'll just push that down there. So in terms of the rest of the balance sheet, the current assets, 7 million of inventory looks pretty high to me, I have to admit. On sales of 12 million to be carrying 7 million of inventory, that's kind of, I mean, again, maybe that's kind of, oh, that's industry standard, but, by my calculation, that means that their inventory turnover, it takes them 372 days to sell that stuff. And well, I'm hoping it doesn't go off, but it just looks really high to me, and that means that that's going to strain their cash flow. Now, it doesn't strain their cash flow too much because they have got lots of cash. So there's nearly 10 million pounds in the bank of cash, so that's looking pretty good. A little bit of trade and other receivables, looks like 50 days receivables, 50 days, 43 days payables, so not a problem, but lots and lots of stock, and that's just I don't know, maybe there's a good reason for it, but that kind of jumps out at me. The current liabilities, only 3 million compared with 20 million. liquidity, not a problem for these guys. Okay, so they've clearly been raising cash. Look at this increase in cash from 2.3 million to 9.6 million. The cash has gone up. They're making a loss. That means that they have been raising cash. How have they been doing it? Clearly not through the borrowings, which are fairly consistent year on year, and that's why they're paying that little bit of interest. And so what they will have been doing is raising cash through equity, and we can see that at the bottom half of the balance sheet. Let me just scroll down a little bit further. We can see that down here, and we can see the share capital. So look at these two numbers here. The share capital and the share premium have increased significantly. So if you are a shareholder, these guys have been issuing shares. They have to issue shares to survive, and that means that you are getting diluted. But they've got a substantial amount of money in the bank. Hopefully they will survive on that cash. So let's look at the cash flow. There's nothing really going on in the movement in equity, no dividends as you'd expect. So if we look at the cash flow, the net cash flow outflow from operating activities, that's this number here. So the net cash flow outflow from operating activities, £5 million. Okay, so that's a fairly substantial figure. Don't forget that the cash they've got in the bank is 9.5, so nearly £10 million. So if you've got 10 million quid in the bank and you're burning at £5 million a year, well, that's a pretty easy mathematical equation to do. So you can see that these guys, they're burning cash. Compared them to last year, the cash burn has gone down, but they are still burning cash. There's the loss and the impairment. The impairment is a non-cash item, so it's added back. No real other changes. You'll notice actually part of that cash burn is increase in inventory. So the inventory, the stock has been going up. That's 8 million. So of that 5 million cash burn, 3 million relates to the or 2.9 million relates to increase in inventory. So it's kind of like, stop putting stuff on the shelves, stop holding stuff in stock, start selling it is kind of the argument that these numbers are telling me. So even if they stop increasing their inventory, that brings the cash flow down to 2 million, and that gives them 5 years of cash burn with 10 million in the bank. So we're starting to get a feel for these guys that they need to start turning the corner. They need to start delivering on the promises that they make in all the glossy brochures, etc., etc. They really need to start making some profits, but they'll be around. They're not kind of teetering on the edge. These guys are going to be around for a few more years. You'll see in the cash flow a little bit of investment going on, property, plant, and equipment. There it is, and really the big numbers in the financing is the gross proceeds from the issue of shares. And then the fees. These are the cost of issuing those shares. So the fees, 900,000. That's paid to the bankers to kind of help them do that. So nearly 15 million pounds raised through a share issue, and hopefully, fingers crossed, that's the last one they have to do. But how many companies have said that is the last one and then gone back again for more? So there is the finances of the company. I don't think there's much more I can add to those numbers. As I said, this is not an area or technology or a kind of a part of the world which I'm particularly familiar with. So I can just give the kind of the numbers that the story that the numbers are telling me. If we have a look at the latest set of accounts, so here are the unaudited sort of interim statements. You'll notice that the sales are kind of they're getting there. 6 months, 6.8 million, which means that you're on target for just over 13 million at the end of the year. Okay, which is back up again. It's not massive. They're making they've got a gross profit. The administrative expenses on target for about 8.5 to 9 million pounds. So again, it's going to be down from last year. So they are still doing the cost cutting. Tells me that these guys, they do, they're conscientious. They're not just going, oh, we'll just keep raising money and throwing cash at the problem. They're trying to cut their costs. They are raising the revenue, but they are still making a loss. Okay, the loss isn't excessive, And if we, as a sort of, rule of thumb, just double that loss to get a 6 month, you can see that the loss is going to be about 3.4 million, for example. Okay, much less than the loss for the year, but then of course that 9.7 is including the 6.4. Add back the 6.4 because it's not going to happen again, and you've got a 3.3 million loss. So they're still there. They're still losing money. They'll still be burning cash. They're not out of the woods yet by any means. So what does all this mean in terms of the markets? Well, obviously, we are backward, or I am backward looking. So I'm very conscious of that. And the markets are, of course, forward looking. And the rear view mirror is a lot clearer than the windshield, as Warren Buffett will tell anybody who listens. So let's look at the share price. Here we go from the max. If you bought in at their IPO, if you bought in when they peaked at nearly 150, you would be nursing some in fact, you basically just given up and gone home. However, that is obviously very much a maximum back in 2009 or 10 when they floated. So much more interesting to look at it recently, and positive numbers there. We're seeing there's no P ratio because they're not making any money. There's no dividend yield because they're not paying out dividends. Obviously, market cap is 4.3. What is that? 44 million based on the shareholders' funds of the equity, which is 29 million. So there's a little bit of a premium, not a massive premium. But then don't forget, these guys, they're going to carry on burning cash, and they're going to burn cash for another year or so at least, I think, until whatever they do comes good and they start actually turning it into kind of bottom line, show me the money kind of, hard and fast figures. However, the markets like them, they're up from 0.4 to 0.6. They're going in the right direction. They're bouncing around again. This is a kind of a day trade, either a day trader's heaven or a hell, depending on which side of the trade you're on. Is it a buy and sell? Is it a buy and hold? I don't know. I think you kind of have to look at the look at the technology, look at the market, and look at the story, and really see if you buy into their story and if you believe that these guys are going to come good. They're not teetering on the edge, but they're not going all guns blazing. This is not a success story yet financially.
Yeah, and on this one, we would love to hear from anyone that knows this company very well, knows the technology, knows the industry really well. Please leave your notes in the comments section below, because this is for the community and we're all learning from each other. So I hope that was of interest and of value to everyone watching this. Again, do leave a note in the comment section if you would like us to analyze a company that you're interested in, whether it's for investment purposes or if you're selling to them, or even if you're thinking about going for an interview with them. So do leave a note in the comment section. So until the next video, thank you, Ted. Thank you, everyone else.
Good to speak to you, Mead. So see you later.